The U.S. markets are currently closed. As of the last market close on Wednesday, October 8, 2025, shares of Webull Corp ended the session at $12.66, down $0.14 or 1.09%. While that daily move might seem minor, it's what's happening beneath the surface with this newly public company that truly demands our attention. The common narrative paints Webull as the next great disruptor in the retail brokerage space, a true competitor to the likes of Robinhood. The expectation is a straightforward story of explosive user growth translating directly into stock market success. The reality, however, is far more complex and tied to the often treacherous path of a company going public via a SPAC merger, a structure that can obscure as much as it reveals about a firm's fundamental valuation and long-term viability. Many people who use platforms for online investing are looking for the next big thing, but the structure of Webull's public debut itself introduces a level of uncertainty that most retail investors simply are not pricing in. Let's first establish the prevailing belief. The excitement around Webull is understandable. It has cultivated a brand that appeals to a more active, data-driven trader than some of its competitors. It offers advanced charting tools, paper trading, and a more robust desktop platform, attracting a segment of the market that might feel it has outgrown the simplified interface of the Robinhood app. The growth numbers are impressive, with millions of users globally. This creates a powerful expectation that Webull is on an unstoppable trajectory, capturing market share from legacy players like Fidelity and Charles Schwab, and even from its closer fintech rival, Robinhood. The story is one of scale, technology, and disruption, a narrative that always finds a receptive audience in the market, especially among those who have seen the meteoric rises of tech stocks like Nvidia stock or Tesla stock. Now, let's challenge that narrative with the underlying reality. Webull became a publicly traded entity not through a traditional IPO, but through a merger with a special purpose acquisition company, or SPAC. While a valid way to enter the public markets, this route can sometimes allow companies to go public with less scrutiny than a conventional IPO process demands. The initial valuation is often set during the deal's negotiation phase, months before the public gets to trade it, and can be influenced by the market sentiment of that specific moment. Consequently, many post-SPAC companies experience significant volatility and a painful period of price discovery once the initial hype fades and the market begins to dissect the financials. We're seeing this play out now. The stock's recent trading pattern isn't just about daily market noise. It's a reflection of the market grappling with Webull's true valuation in a landscape where the cost of acquiring a new user is rising and the primary revenue source, payment for order flow, PFOF, is under constant regulatory threat. This isn't a simple growth story. It's a high-stakes bet on a business model with significant inherent risks. Looking at the recent trading dynamics, the volume on Webull stock has been a key indicator. In the initial days following the merger's completion, trading volumes were elevated, driven by arbitrage funds unwinding their positions, retail speculators, and investors who had followed the SPAC from the beginning. However, we've seen those volumes begin to normalize, and on days like yesterday, the movement feels less driven by conviction and more by broader market currents. What we need to watch for is institutional accumulation. Are large asset managers and hedge funds establishing positions, or are they waiting on the sidelines? The lack of significant disclosed institutional buying so far suggests that the smart capital may be waiting a few quarters of public financial reporting to get a clearer picture of profitability trends and user monetization metrics. This is a critical divergence from the retail expectation. While individual investors using their individual brokerage accounts accounts are buying into the growth story, the larger players, who often provide a floor for a stock's price, seem to be exercising caution. For anyone looking for investment help, understanding the flow of institutional funds is a crucial piece of the puzzle. The entire online brokerage sector is navigating a tricky macroeconomic environment. During periods of low interest rates and high market volatility, platforms like Webull, SoFi Invest, and Robinhood thrived. Stimulus checks and stay-at-home orders created a perfect storm for retail trading. Now the environment has shifted. Higher interest rates mean the cost of capital is higher, and speculative assets become less attractive. While brokerages can benefit from higher interest income on uninvested customer cash, this is often offset by a decline in trading volumes, particularly in high-margin products like options. Webull's user base is skewed towards more active traders, which makes it particularly vulnerable to a slowdown in trading activity. This is a headwind that the simple user growth narrative fails to adequately address. Its performance can't be viewed in a vacuum. It's deeply connected to the risk appetite of the average retail investor, which is in turn dictated by the health of the broader economy. It's not enough to simply offer a slick trading platform. The macro tide needs to be in your favor. So, what exactly is Webull's business? At its core, it's a technology company offering a commission-free electronic trading platform. Users can open an account, often through a simple mobile app, and trade stocks, ETFs, and options without paying a per-trade fee. The company makes its revenue primarily in three ways: payment for order flow, where it routes user trades to market makers who pay for that volume; margin lending, where it earns interest from users who borrow to trade; and data subscriptions for advanced market data. This PFO model is the same one that powers Robinhood stock and has been the subject of intense debate and regulatory scrutiny. The SEC has questioned whether this model truly benefits the end investor or if it creates a conflict of interest. Any new regulation that curtails or bans PFOF would fundamentally break the business model of Webull and its peers, forcing a shift to a subscription or per-trade fee structure, which could dramatically slow user acquisition. This is the single greatest existential risk to the company, and the current stock price does not seem to be fully accounting for this binary outcome. Looking at its competition, the field is more crowded than ever. On one side, you have the legacy giants. Fidelity Investments and Charles Schwab have massive scale, trusted brands, and have largely matched the zero-commission offerings of the fintech upstarts. They offer a complete suite of services, from Fidelity Wealth Management and Fidelity IRAs to sophisticated intelligent portfolio solutions like Schwab Intelligent Portfolios. Then you have direct fintech competitors. Robinhood has immense brand recognition, particularly among younger investors, and has expanded into areas like Robinhood Crypto and Robinhood Cash Management. SoFi is building an all-in-one financial ecosystem with its SoFi investing platform integrated with banking, loans, and other services. Then you have platforms like Interactive Brokers, which caters to the truly professional and highly active trader with its advanced Interactive Brokers trading platform and competitive Interactive Brokers fees. Webull is caught in the middle, more sophisticated than Robinhood, but less comprehensive than Fidelity or Interactive Brokers. It needs to carve out and defend its niche relentlessly. With the intense competition from platforms like Robinhood and the established players like Fidelity, what unique feature do you think Webull need to add to secure its market position? Comment below. The future outlook for Webull hinges on its ability to navigate these challenges. The bull case, the expectation, is that it can continue its international expansion, successfully launch new products like automated investing or retirement accounts, and effectively monetize its growing user base. The hope is that it can transition from a high-growth, cash-burning startup into a sustainable public company. Success would mean a stock price that grows to reflect not just its user count, but its actual earnings per share. This is the future investors are hoping for when they invest on online through platforms that offer self-investing. However, the bear case, the reality check, is substantial. Regulatory headwinds could cripple its primary revenue stream. A prolonged bear market could sap retail enthusiasm and slash trading volumes. And the intense competition could lead to a price war or an unsustainable marketing spend just to maintain market share, indefinitely delaying profitability. The company could find itself in a perpetual struggle for scale, unable to achieve the operating leverage needed to satisfy public market investors. Think about the difference in business models. A company like Apple stock sells premium products with high margins, whereas Webull's core product is free and its revenue is transactional and highly cyclical. This is a much tougher business to be in, especially as a newly public company still trying to prove its model works at scale. In summary, the story of Webull is a classic case of expectation versus reality. The market expectation is for a seamless continuation of its private market growth story, a fintech disruptor destined to reshape the world of online investment. The reality is that of a company facing a gauntlet of challenges.